History reveals a recurring cycle that has led to the downfall of every dominant global currency. This isn't a matter of probability, but of predictable progression, a sequence that has unfolded 4 times over the past 6 centuries. The Portuguese real held sway for 80 years before its collapse. The Dutch guilder endured for 80 years before its decline. The British pound reigned supreme for 105 years before its demise. Each of these currencies followed an identical 7-stage trajectory, and each era believed its monetary system was uniquely resilient and everlasting. The United States dollar assumed the mantle of global reserve currency in 1944, a period of 81 years prior to the present. As of the year 2025, the dollar is situated within the 5th stage of this established 7-stage pattern. The paramount concern is whether humanity possesses the wisdom to foresee this inevitable outcome, or the hubris to dismiss the possibility, believing this time will be different. Allow me to illuminate this historical pattern, detailing the 7 phases every reserve currency traverses and pinpointing the dollar's current position. Before delving into the stages, it's crucial to grasp the essence of a reserve currency. It transcends mere economic strength. It is the currency held by central banks of other nations, the benchmark for pricing global commodities, and the medium through which international trade is conducted. As the holder of the reserve currency, a nation commands universal demand for its money. To acquire essential resources like oil, other countries must procure this currency. To reconcile trade imbalances, this currency is indispensable. For secure asset holdings, foreign nations invest in the reserve currency nation's bonds. This generates what is termed exorbitant privilege. The nation can essentially print its money and exchange it for tangible goods from other countries, which must produce goods to acquire this currency. The reserve currency issuer can sustain perpetual trade deficits as foreign entities require its currency for their own reserves. Furthermore, they can secure loans at lower interest rates due to sustained global demand for their bonds, a demand rooted in necessity rather than choice. Possession of reserve currency status represents the ultimate economic leverage, the very prize for which empires strive, and the very reason for their subsequent downfall. Now let us examine the 7 stages. As we progress through them, the dollar's present location will become evident. Stage 1 is characterized by military supremacy and control over trade arteries. Every reserve currency originates from an overwhelming military might that secures dominion over vital global trade routes, not merely possessing a formidable military, but actively controlling the conduits through which international commerce flows. In the 1540s, Portugal achieved an unprecedented feat: mastery of oceanic navigation. While other European powers remained confined to coastal waters, Portuguese mariners charted courses across open oceans. Their circumnavigation of the Cape of Good Hope in 1488 unveiled a maritime route to Asia, circumventing the Ottoman-controlled overland passages. This advantage was amplified by military might. Portuguese warships dominated the Indian Ocean, the South China Sea, and the Atlantic. They established fortified trading outposts at strategic junctures, including Goa, Malacca, Macau, and Mozambique. These were not mere ports, but heavily armed fortresses, from which Portuguese cannons dictated access to trade and its terms. Aspiring to acquire spices from the Moluccas necessitated dealings with Portugal. Engaging in commerce with India required Portuguese authorization. They imposed fees, levied tariffs, and seized vessels that attempted to bypass their system. This military control of trade routes elevated the Portuguese real to the status of the preeminent currency in global commerce. Merchants across Europe, Africa, and Asia required reals to conduct transactions within Portuguese-controlled territories. It became the currency of international commerce, not due to its gold backing or inherent economic superiority, but because it was underpinned by military power. The Dutch replicated this pattern in the 1600s. The Dutch East India Company was more than a mere trading entity. It was a formidable military force, boasting its own army and navy. At its zenith, the VOC commanded 40 warships and employed 20,000 soldiers. They captured Portuguese trading posts, seized control of the Spice Islands, and established Amsterdam as the epicenter of global trade. Dutch vessels traversed the Baltic, the Atlantic, and the Indian Ocean. Commerce necessitated the use of guilders, the currency of the nation that commanded the seas. Britain perfected this model in the 1800s. At its peak, the Royal Navy surpassed the combined naval strength of the next 5 nations. The adage, "Britannia ruled the waves," was not poetic license but a stark reality. The British held sway over crucial global trade, choke points such as the Suez Canal, Gibraltar, Singapore, and the Straits of Malacca. Every pivotal artery of global commerce was under British dominion. The pound sterling ascended to global currency status because British naval power rendered international trade impossible without it. The United States attained a similar position following the Second World War, not solely through military strength, but by dominating the global trade infrastructure. The U.S. Navy commands all oceans with 11 aircraft carrier battle groups, more than the rest of the world combined. The United States controls or maintains bases proximate to every critical trade choke point, including Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. This dominance serves not the defense of America, but the control of global commerce, making international trade contingent upon American acquiescence. This marks stage 1, military dominance over trade routes. The dollar achieved this in 1945 and maintains it to this day. Stage 2 is characterized by a substantial trade surplus and the accumulation of global wealth. Once control over trade routes is established, a nation begins to amass wealth from the rest of the world, not through expropriation, but via advantageous exchange. Portugal in the 1500s generated significant trade surpluses. They acquired spices, silk, and porcelain from Asia using gold and silver. However, they exported European goods such as textiles, weaponry, and enslaved Africans at exorbitant markups. The balance of trade consistently favored Lisbon. Portuguese vessels returned laden with Asian commodities that commanded 10 times their purchase price. This surplus transformed Lisbon into one of Europe's most prosperous cities. The revenue generated from trade by the Portuguese crown was so substantial that it fully funded the entire government without imposing heavy taxes on the domestic population. The Dutch in the 1600s pursued this strategy with even greater systematic efficiency. Amsterdam became the world's emporium. Goods from Asia, the Americas, and Africa flowed through Amsterdam. The Dutch practiced buying low in one market and selling high in another, capturing the price differential. They were not merely traders but global-scale arbitrageurs. The Dutch trade surplus was so immense that Amsterdam overflowed with wealth, its canals lined with opulent mansions, its merchants wealthier than many European monarchs. Britain in the 1800s achieved the largest trade surplus in history up to that point. They exported manufactured goods, including textiles, steel, machinery, and vessels, to the global market. They imported raw materials like cotton, tea, and rubber at prices dictated by British purchasers. The terms of trade were unilaterally set by London. This surplus propelled Britain to become the wealthiest nation on earth. London's financial district managed more capital than the rest of Europe combined. The United States experienced the most dramatic trade surplus in history between 1945 and 1970. Following the Second World War, America was the sole major industrial power with intact infrastructure. Europe and Asia were engaged in reconstruction. The U.S. exported machinery, automobiles, steel, and consumer goods worldwide. The trade surplus was so substantial that dollars poured into foreign central banks faster than they could be recirculated. U.S. gold reserves swelled dramatically, with Fort Knox holding over 20,000 tons of gold by the 1950s, exceeding the combined holdings of the rest of the world. This represents stage 2, massive trade surpluses, the aggregation of global wealth through advantageous commerce. The dollar achieved this status from 1945 to 1970. However, this is where the established pattern begins to diverge. Stage 2, by its nature, is not enduring. Eventually, the nation whose currency serves as the global reserve transitions from being a producer of goods to a consumer, from an exporter to an importer, and from a surplus-generating economy to one with deficits. This marks the commencement of Stage 3. Stage 3 is the formalization of reserve currency status, the critical turning point. At a certain juncture, the world officially recognizes and adopts the nation's currency as the global reserve. This moment signifies the apex, the zenith of power. For Portugal, this occurred in the early 1500s. European nations and Asian merchants formally acknowledged the real as the principal currency for international transactions. Treaties were drafted, denominating trade in reals, thereby establishing it as the prevailing standard. For the Dutch, this transition took place in the mid-1600s. The guilder became the preferred currency for international contracts, with bills of exchange routinely denominated in guilders. Even the British East India Company utilized guilders for certain transactions, reflecting the unparalleled liquidity of Amsterdam's financial markets. For Britain, this recognition materialized at the Congress of Vienna in 1815. following the Napoleonic Wars. The pound sterling was explicitly affirmed as the global standard. International agreements, loans, and trade accords were denominated in pounds. The gold standard, adopted by most nations, effectively became a pound standard due to Britain's regulatory influence. For the United States, this formalization occurred at the Bretton Woods Conference in 1944. 44 nations convened in New Hampshire and formally agreed to designate the dollar as the world's reserve currency. Other currencies were pegged to the dollar, which in turn was pegged to gold at $35 per ounce. The International Monetary Fund and the World Bank were established to oversee this system, representing the most explicit formalization of reserve status in history. However, a critical aspect often overlooked regarding Stage 3 is that it represents the peak. This is the most advantageous position attainable. The very act of formalizing reserve status inadvertently sows the seeds of its own undoing. Once a currency is designated as the global reserve, the world's demand for that currency exceeds its demand for the issuer's goods. Consequently, the reserve currency nation begins to reduce its production of goods and increase its imports. The trade surplus reverses into a deficit, which then becomes entrenched. This phenomenon is known as the Triffin dilemma, articulated by economist Robert Triffin in 1960. For the world to possess an adequate supply of dollars for use as reserves and for trade, the United States must incur trade deficits, thereby circulating dollars abroad. However, the persistence of these deficits gradually erodes the currency's value. It is mathematically impossible to simultaneously maintain global reserve currency status and a robust trade balance. Thus, every reserve currency, upon reaching Stage 3, embarks on a trajectory towards Stage 4. Stage 4 is characterized by deficit spending and living beyond one's means, signifying a reversal. This is where the pattern becomes irreversible. The nation whose currency holds reserve status ceases to generate wealth and begins to consume its accumulated assets. Portugal experienced this reversal in the mid-1500s. The trade surplus vanished. Instead of exporting goods, Portugal became a net importer of everything, from grain from Sicily and textiles from Flanders to manufactured goods from across Europe. These imports were financed by gold and silver procured from Brazil and Africa. However, this represented the expenditure of previously accumulated wealth, not the creation of new wealth. The spending of the Portuguese crown escalated dramatically. King John III indulged in lavish expenditures on palaces, churches, and the royal court. Military campaigns to maintain the empire also drained resources. Crucially, the problem went largely unnoticed because the influx of capital continued. As long as gold from Brazil continued to arrive, spending could be sustained. However, this gold supply was finite, and productive investments were not being made. The nation was consuming its capital. The Dutch followed a similar path in the 1700s. After a century of trade surpluses, the Netherlands transitioned to becoming net importers. The affluence of Amsterdam fostered a sense of complacency among its citizens. Why engage in factory work when one could subsist on accumulated capital? Dutch investment shifted from trade and production towards finance, transforming them into bankers for Europe and lending to other nations rather than producing goods. While this generated income, it was passive rather than a driver of productive growth. The trade balance reversed, with imports exceeding exports. This deficit was financed by liquidating accumulated wealth. Britain faced the same reversal in the early 1900s. By 1900, Britain was running trade deficits, importing food, raw materials, and increasingly manufactured goods. These imports were paid for by returns on overseas investments. Centuries of accumulated wealth were invested in railroads, mines, and enterprises throughout the empire. While investment income was substantial, it represented the extraction of wealth generated elsewhere, not the creation of new wealth domestically. British manufacturing experienced a decline, with factories that had once led the Industrial Revolution closing or falling behind their American and German competitors. The trade deficit widened annually, reflecting a pattern of living beyond their means, financed by the liquidation of past prosperity. The United States entered Stage 4 in 1971, the year the trade surplus permanently shifted into a deficit. By the 1980s, the deficit was growing at an accelerated pace. By the 2000s, the U.S. was experiencing the largest trade deficit in history, amounting to $800 billion annually. The U.S. imports significantly more than it exports, including consumer goods, electronics, automobiles, and textiles, all sourced from abroad. This is financed by exporting dollars, printing currency, and exchanging it for tangible goods. This mechanism is viable solely because the dollar is the reserve currency, Other nations required dollars for their reserves and trade, thus accepting them. However, this constitutes living beyond one's means, consuming more than is produced, and mirrors the pattern that preceded the collapse of every preceding reserve currency. Stage 5 is currency debasement and excessive money printing, a desperate measure. When deficits become unsustainable and borrowing is insufficient to fund expenditures, the currency is debased through extensive money printing. Portugal resorted to this in the 1550s. Facing mounting deficits and declining trade revenues, the Portuguese crown began to debase the real by reducing the silver content in its coins and issuing more currency than the available metal could back. This led to inflation, causing prices to rise. Merchants began to refuse reals or demand higher quantities for goods, diminishing the currency's purchasing power. By the 1570s, the real was losing credibility, and international merchants increasingly favored other currencies for trade. The Dutch employed a similar strategy in the 1700s. The guilder had initially been supported by a robust banking system and conservative monetary policies. However, by the mid-1700s, the Dutch government incurred significant debt to finance wars and maintain its colonial empire. When borrowing became prohibitively expensive, they resorted to inflating the currency by printing money to cover deficits, leading to a decline in the guilder's value. By the 1780s, it was no longer the preferred currency for international trade. Britain debased the pound through 2 world wars. The First World War compelled Britain to print money and temporarily abandon the gold standard. They returned to gold in 1925, but at an overvalued rate, which precipitated economic hardship. The Second World War forced them off gold permanently. By 1945, the pound was floating and experiencing a decline in value. Britain printed money to finance reconstruction and the welfare state, leading to repeated devaluations of the pound. In 1949 and 1967, each devaluation eroded international confidence. By the 1970s, the pound had ceased to be a reserve currency, relegated to regional status. The United States entered Stage 5 in 2008. The financial crisis necessitated unprecedented money printing by the Federal Reserve, a process known as quantitative easing. $3.5 trillion were created between 2008 and 2014. Subsequently, the COVID-19 pandemic prompted the printing of an additional $7 trillion between 2020 and 2022. The money supply expanded at a rate unparalleled in American history outside of wartime. This represents currency debasement, not through reduced metallic content in coins, but through the expansion of fiat currency. The effect remains consistent: a decline in the dollar's purchasing power and surges in inflation. In 2021 and 2022, inflation reached levels not witnessed in 40 years. The crucial difference between the US and previous reserve currencies lies in scale. The dollar's global reach means that when the Federal Reserve prints money, it exports inflation worldwide. Other nations observe their dollar reserves diminishing in value. While their dollar-denominated debt becomes less costly to repay, their imports from the United States become more expensive. This stage marks the initial erosion of confidence, and once confidence falters, Stage 6 rapidly ensues. Stage 6 is characterized by a loss of confidence and a search for alternatives, the breaking point. This is the period when the global community begins to seek alternatives. As trust in the reserve currency wanes, nations start reallocating their reserves toward other options. Portugal experienced a loss of confidence in the 1570s and 80s. International merchants began demanding payment in Spanish silver or Venetian ducats rather than Portuguese reals. Trade contracts increasingly specified other currencies. Asian merchants who had accepted reals for decades started refusing them or demanding higher quantities to compensate for debasement. By 1580, when Spain annexed Portugal, the real had already become functionally obsolete as a reserve currency. The annexation merely formalized a market reality. The Dutch guilder experienced a decline in confidence throughout the 1700s. The French, British, and other European powers began holding a greater proportion of their reserves in alternative currencies. By the 1780s, Amsterdam was no longer Europe's financial hub. London had assumed that position. While the guilder continued to be used in regional trade, it was no longer the primary currency for major international transactions. This transition, though gradual, was irreversible. The British pound rapidly lost confidence following the Second World War. In 1945, Britain owed substantial war debts to the United States and other allies. The pound was overvalued and sustained solely by American loans. In 1949, Britain devalued the pound by 30%, resulting in an immediate loss of nearly a third of its value for international holders. Confidence collapsed, and nations began shifting reserves from pounds to dollars. By 1960, the pound's share of global reserves had plummeted from over 60% in 1945 to less than 20%. The transition from pound to dollar was completed within 15 years. The United States dollar is currently in the nascent stages of Stage 6. The indicators are pervasive. China and Russia commenced reducing their dollar reserves in the 2010s, opting instead to acquire gold, accumulating thousands of tons. China's official gold reserves have more than doubled since reaching 8,000 tons, though unofficial estimates suggest far greater holdings. Following sanctions imposed in 2014, Russia liquidated nearly all of its U.S. Treasury holdings. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been discussing alternatives to the dollar for trade. In 2023, they announced plans for a BRICS currency. While not yet launched, the mere discussion of such a currency is significant. Saudi Arabia, which had priced oil in dollars since 1974, forming the bedrock of the petrodollar system, began accepting yuan for oil sales to China in 2023, a departure from a 50-year precedent. Central banks globally are diversifying their reserves. The dollar's share of global reserves has decreased from 72% in 2000 to 58% in 2024, a decline of 14 percentage points. While this may seem modest, it represents trillions of dollars shifted out of dollar-denominated assets, with the euro, yuan, and gold absorbing most of this capital. Even smaller nations are reducing their dollar exposure. Thailand, Malaysia, and Indonesia are negotiating trade agreements settled in their local currencies, bypassing the dollar. This signifies the onset of Stage 6, with the world actively seeking alternatives. This shift is not driven by animosity toward America, but by recognition of the identical pattern that led to the downfall of every prior reserve currency: persistent deficits, currency debasement, and a loss of purchasing power. Nations are not awaiting Stage 7. They are proactively positioning themselves. Stage 7 signifies replacement and collapse, the definitive end. This is when a new currency emerges to supplant the old, not through formal decree but through market adoption. The world collectively ceases to utilize the defunct currency and embraces the new. The Portuguese real was superseded by the Spanish silver peso in the late 1500s. Spain had conquered vast silver mines in the Americas, notably Potosi in Bolivia and Zacatecas in Mexico. These mines yielded more silver than the rest of the world combined. Spanish silver coins became the preferred currency for international trade due to their abundance, standardization, and backing by ongoing production. The weakened, devalued, and deteriorating Portuguese real could not sustain its position. Merchants abandoned it. This shift unfolded over a period of 2 decades. By the year 1600, the real had become insignificant. The Dutch guilder was supplanted by the British pound in the late 1700s and early 1800s. Britain's industrial advancements and naval supremacy positioned the pound as the clear successor. London's financial hubs grew more robust and liquid than Amsterdam's. The pound was underpinned by Britain's manufacturing and commercial might. This transition spanned approximately 30 years. By 1815, following the Napoleonic Wars, the pound reigned as the unchallenged global monetary standard. The guilder by then was merely a regional tender. The British pound was superseded by the US dollar between 1945 and 1960. While the transition was officially recognized at Bretton Woods, its full implementation took several years. Britain found itself bankrupt in the aftermath of World War II. The United States possessed the majority of the world's gold reserves and was the sole nation with an intact industrial infrastructure. The dollar emerged as the only currency capable of fulfilling the role of a global benchmark. The pound experienced a series of devaluations. By 1967, with yet another devaluation of the pound, it was evident that the dollar had definitively taken its place. Therefore, what will ultimately succeed the dollar? This is the query on everyone's lips. The answer remains elusive because we have not yet reached Stage 7. We are currently in Stage 6, which involves the exploration of alternatives. However, history offers valuable insights. The succeeding currency typically originates from the nation asserting military dominance over trade routes, maintaining a trade surplus, and possessing significant productive capabilities. Presently, no single nation embodies all these characteristics. China boasts a trade surplus and production capacity, but it does not exercise military control over global trade routes. The renminbi is not freely convertible. China's capital controls preclude it from becoming a true reserve currency. A currency cannot function as a reserve if its movement in and out of a country is restricted. The euro stands as the second most held reserve currency. However, Europe grapples with profound structural challenges, including an aging demographic, a lack of unified fiscal policy, and reliance on external energy sources. Germany possesses manufacturing strength, but Southern Europe does not. It is a fragmented economic system. Gold is experiencing a resurgence in popularity. Central banks are acquiring more gold than at any point since the 1970s. Gold, unlike fiat currency, cannot be artificially created or devalued. However, it lacks the scalability to accommodate trillions in daily transactions. The global supply of gold is insufficient to back the sheer volume of international trade. Some experts propose that the replacement may not be a single currency, but rather a composite. Perhaps the International Monetary Fund's special drawing rights, a basket of currencies, will become the prevailing standard. Alternatively, technological advancements might pave the way for a novel digital currency, potentially backed by a commodity or an algorithm. Proponents of Bitcoin believe that cryptocurrency will supplant fiat money, yet governments are unlikely to willingly cede monetary control to a decentralized system. The most probable outcome is a turbulent transition. This period will likely be characterized by multifaceted currency competition, with various regional currencies dominating distinct trade blocs. The dollar could hold sway in the Americas, the euro in Europe, the renminbi in Asia, and gold might be utilized for inter-block settlements. Such a scenario would not be orderly. It would be volatile, unstable, and economically taxing. Nevertheless, this is how transitions occur when a clear successor is absent. Now, allow me to elucidate why this information is crucial for you. Understanding this recurring pattern is not merely an academic exercise, it is a matter of survival. When reserve currencies falter, the repercussions extend beyond governments, devastating the savings and wealth of ordinary individuals. The decline of Portugal in the late 1500s plunged the Portuguese Empire into economic hardship. Merchants holding the real witnessed their fortunes vanish. The economic collapse of the Netherlands in the 1700s profoundly impacted Amsterdam's middle class. Savings denominated in guilders plummeted in value. Investments tied to the guilder became worthless. Britain's post-World War II economic downfall impoverished an entire generation. British citizens holding pounds invested in government bonds or with pensions denominated in pounds, all experienced a loss of purchasing power as the currency underwent repeated devaluations. The erosion of the American dollar is unfolding gradually. Every dollar you possess is losing its purchasing power. Since the year 2020, inflation has diminished the dollar's value by approximately 25%. Your savings, your salary, your retirement fund, if denominated in dollars, now purchases 25% less. This is merely the initial phase of Stage 6. If historical precedent holds true, and the dollar follows the same trajectory as all previous reserve currencies, the coming decade will witness escalating depreciation, intensified inflation, a further reduction in purchasing power, and an increasing number of nations divesting themselves of dollars. And when Stage 7 arrives, the moment of replacement, there will be a period of collapse, a currency crisis. The dollar could shed half its value within a matter of months. This very scenario befell the pound in 1949. It is a possibility for the dollar. So, what course of action should you take? Firstly, recognize that holding dollars presents a risk, not a safe haven. The dollar's reserve status is diminishing, albeit gradually at present, but this trend is accelerating. Diversify your holdings away from exclusive dollar exposure. This does not necessitate abandoning dollars entirely. If you reside in the United States, you require dollars for daily living. However, do not concentrate all your wealth in dollars. Invest in assets that retain value across different currencies, such as real estate, productive enterprises, and commodities. These assets maintain their worth irrespective of the prevailing currency. Secondly, monitor the indicators of Stage 6. Observe central bank reserve data. A marked decrease in dollar reserves signals an acceleration of the transition. Pay attention to trade agreements. If major nations begin conducting trade settlements in alternative currencies, this is a significant sign. Watch the price of gold. A surge in gold prices indicates a global flight from fiat currencies in general. Thirdly, comprehend that this issue transcends politics. It is not a matter of personal preference regarding American policies. It is a question of mathematics. The same mathematical principles that led to the demise of the real, the guilder, and the pound are at play. Every reserve currency adheres to a predictable 7-stage cycle. The dollar is currently in stage 5, progressing towards stage 6. This pattern is impervious to notions of exceptionalism or national prestige. It is driven by deficits, debt, and the erosion of currency value. By these metrics, the United States is meticulously following the established script. Let me present information that should be deeply concerning. The historical timeline. The Portuguese real maintained its reserve currency status for 80 years, from 1450 to 1530. The Dutch guilder endured for 80 years, from 1640 to 1720. The British pound held its position for 105 years, from 1815 to 1920. Each currency persisted for approximately 80 to 110 years. The US dollar attained reserve status in 1944. That was 81 years ago. We are at the average lifespan, and the economy is exhibiting all the hallmarks of late-stage decline, substantial deficits, currency devaluation, and a waning of confidence. The search for alternatives is underway. The pattern dictates what comes next. Stage 7, replacement. However, this time presents a genuine departure from the norm, not merely a fleeting delusion of uniqueness. Each prior reserve currency collapse was confined to a regional scope. The downfall of the real impacted Portugal and its trading partners. The decline of the guilder affected Amsterdam and Northern Europe. The collapse of the pound was felt by Britain and the Commonwealth. In contrast, the implosion of the dollar will be global in its reach. The dollar is deeply integrated into every economy, every central bank, every trade transaction, and the pricing of all commodities, including oil, gold, and wheat. When the dollar loses its reserve status, no segment of the global economy will remain unaffected. Consequently, this transition will be more tumultuous than any preceding monetary shift. There is no readily available successor poised to assume its role. The sheer volume of dollar-denominated debt worldwide, exceeding $70 trillion in bonds alone, means that a dollar collapse will trigger defaults across every continent. Emerging economies that borrowed in dollars will be unable to meet their obligations. Corporations that issue dollar bonds will face bankruptcy. Even developed nations holding dollar reserves will witness the implosion of their central bank balance sheets. The systemic risk is orders of magnitude greater than in 1949, when the pound collapsed, or 1780, when the guilder declined. This is not merely a currency transition, it represents a fundamental restructuring of the entire global financial system. And such restructurings are invariably arduous, chaotic, and destructive to existing wealth. Let me be unequivocally clear about what I am not asserting. I am not claiming the dollar will collapse tomorrow. I am not suggesting the United States will devolve into a failed state. I am not advising you to panic and liquidate all your assets. What I am conveying is that a discernible pattern exists. 7 stages, 4 historical precedents, and the US dollar is presently in stage 5, transitioning into stage 6. The historical timeline suggests we have perhaps 10 to 20 years remaining before stage 7, possibly less if the transition accelerates, or potentially more if the United States can somehow deviate from this established pattern. However, breaking this pattern requires actions that no previous reserve currency issuer has managed to achieve. It necessitates rectifying deficits, ceasing the printing of money, and rebuilding productive capacity. These are not simply policy choices. They are politically formidable challenges because they demand short-term hardship for long-term stability. Democracies, however, tend to eschew hardship in favor of comfort, stimulus, and the printing of money to postpone difficult decisions. Thus, the pattern persists. Stage 6 intensifies, leading into stage 7. And individuals who comprehend this phenomenon position themselves accordingly. They diversify their holdings beyond solely dollar-denominated assets. They acquire tangible assets. They meticulously monitor the relevant indicators. And when stage 7 materializes, the moment of replacement, they will not be caught holding a collapsing currency. Instead, they will possess assets that retain their value across various currencies. This is precisely what the Portuguese merchants did when they observed the real's decline. They shifted their wealth to Spanish silver. This is what the Dutch bankers did as the guilder weakened. They transferred their fortunes to London. This is what the British elite accomplished after World War II. They moved their wealth into dollars and dollar-denominated assets. And this is what astute investors are undertaking presently, not impulsively or in a panic, but systematically and discreetly over time. The phenomenon of declining reserve currencies is not a conspiracy. It is a recurring historical cycle documented over 6 centuries. encompassing 7 stages, 4 currencies, and now a 5th. The sole determinant is whether you will recognize it before its completion, or whether you will become the liquidity that transfers wealth to those who have. The pattern is unmistakable. The timeline is evident. The dollar is in stage 5, and history dictates that stages 6 and 7 will follow not as mere possibilities, but as probabilities bordering on certainty. This is the manner in which reserve currencies meet their end, not through invasion or catastrophe, but through mathematics. It begins slowly, then accelerates, initially ignored, then undeniable. And by the time its reality is universally acknowledged, the transition is already complete. If this revelation has altered your perception of the dollar, the global economy, and what lies ahead, then you're beginning to discern the underlying pattern. It has manifested 4 times previously, spanning 80 to 110 years, with 7 distinct stages, and it is unfolding once more at this very moment. Subscribe if you wish to track stage 6 as it progresses.